Our next speaker, Shri Salim Gangadharan, was the director nominee of RBI for Central Bank of India. He had been with RBI over 36 years and is currently retired as of 31st of October as the regional director of RBI Thiruvananthapuram. He was also a member faculty in the Bankers Training College of the RBI for 5 years and handled several seminars and conferences on the risk management, payment systems, and treasury management, etc. He was also on secondment to the Central Bank of Oman for 5 years. He was associated with the IMF team to assess the need for convergence in supervisory practices across the GCC countries as part of the proposed monetary union. He was part of several internal working groups in the RBI Government of India. I request CA Gopal to kindly escort our special speaker, Shri Salim, onto the stage, please.
Good afternoon. First of all, let me congratulate and appreciate the Bahrain chapter of the ICAI in organizing this international conference. So because of the time constraint, I will straight away go into the area. So Dr. Vasudevan, my guru in the RBI, has set the macro perspective of the issue. What I will try to do is the micro aspect of it and a little bit of statistics and discussion. I think we'll spend more time on question and answer other than my presentation. If you look at the macro economy in India, because my entire discussion is going to be focused on India and its interface with the external sector, what we are facing is a slowing down the growth. When I have written it 2 days back, it was slowing down, but yesterday evening we had the Q2 GDP figure. It is now going up, but nevertheless it is much lower than what is happened in the past, and 4.4 and 4.8. And currently our targeted growth is around 5%, and unless for the next 2 quarters we are growing by 4%, we are not going to achieve the target of 5%. But one thing is very interesting is that there is a turnaround of the agriculture sector. You have seen it. And the industry sector or the manufacturing sector is lagging. But the most distinct feature of the Q2, even though we have increased our growth to 4.8, the services sector which drives the Indian economy, or it is 67 plus of our GDP shared, which has slowed down, compared to even 6.2. So the entire focus now for a turnaround depends on the services sector. I think that is what the government of India or the other authorities should be looking at. This is just a statistical narration of the quarterly movements, may not be, you can see it later. But when you look at the slowdown, there are various arguments in the press, in the media, in the associations and all. Maybe when you look at broadly, the supply constraints is one driving factor, particularly the infra sector. The high inflation is also dragging the growth downwards. There are cyclical factors. Then what is happening is, because of the global financial crisis, there is a near stagnancy of the international trade. So naturally, India is also an export-oriented economy. So anything happens to the external demand, it is putting down the demand function of the economy. And particularly last 2 years, we had a bad monsoon. And in India is also consumption-driven economy. Since there is a rural sector slackness, there is a compression of demand in the rural segment. But a green shoot is that now the monsoon is doing it has done very well, and the sowing season has gone up by 5%. So there is a renewed demand for higher growth of consumption from the rural segment. This is going to do a good thing for us. And one is the very worst factor is the savings and the investment both are coming down in the country, and there is a business sentiment. So I thought I'll just take you to a few aspects of this one. Agriculture, of course, the past it is a weak monsoon, and currently it is a good monsoon. And current year statistics shows that the area sown for agriculture purposes has gone up by 5%. That is evidently demonstrated in the Q2 growth of the agriculture sector. So what is happening in the industry are, there is a mining, all of you know there are so many corporate governance issues So the mining sector has impacted very badly, and gradually we are coming out of it. And infrastructure sector near stagnancy, a lot of big projects are held up, and particularly in the power and road sector. So this is one of the factor which is pulling down the growth. And there is, of course, the tight monetary policy pursued by the RBI has also impacted investment and the growth to some extent. So what is happening is the agriculture and industrial growth. See, combination of these two sectors are influencing or cascading into the services sector, which is also contributed to significant share of our growth. These are the broad growth issues. So one of the very important aspects you can look at either from the gross capital formation or domestic savings, there is a significant fall. You can just take two statistics. In 2010-11, our savings rate was 34. It is almost coming down 3.2% 2011 and 12 because the 12-13 figure is to be coming out. What is distinctly happening is in the household sector because of the high inflation, they are opting for physical savings rather than the financial savings. You can see the statistics. In 2010-11, the financial savings was around 10.3, and it is almost 7.5%. So you must have seen a lot of gold is purchased by the household sector, a lot of investment in the real estate sector. So this is one of the weak points since it is not coming in the form of financial savings, it is not going into capital formation directly into productive activity. This is one of the factors which is impacting. Because why I'm raising all these issues that there is a focus saying that the monetary policy alone is pulling down the growth and the rest of the things are okay. But what we wanted to put it on balance is not everything is okay. There are some structural constraints which needs to be addressed for pushing the growth to 9 or 10%. Then similarly on the investment side, you can see the investment is coming down again 36.8% to 35%. So there is a slackness. And the most important thing is RBI does a quarterly industrial outlook survey. That is one of the index we prepared is a business expectation index for the quarter one. And quarter two, the data is given. It is almost 3.9 points. It has come down. So there is a lot of confidence. Index is down. The industry is not prepared to invest, commit more resources. More capacity is not created. So this is one of the sentiments which is also impacting into the industry. So when you are looking from the outlook side, there are so many green shoots are there. One is the rural monsoon is one of the best monsoons we had in the past year. It is above 6% of the normal average. And another aspect is because of this good monsoon, the rural demand is coming in. Now the external sector demand is coming up. Our export has gone up by around 13 plus in US dollar terms, even though there is an international trade is near stagnant. And the power sector is doing extremely well. This electricity generation in the first half, it has gone up by 7.7%. And there are so many policy initiatives taken from the RBI side or from the government of India side. Particularly the PMO's office has created a special joint secretary level monitoring mechanism for all the pipeline projects and the new projects in the infrastructure sector are given a big leap. So these are going to then there is a gross fiscal deficit which they wanted to contain exactly at 4.8% what is budgeted in the budget, even though that October data shows that 84% of the fiscal deficit is already used up, but there is a commitment from the government side. So a lot of outlook is coming up, but the most important challenge we are facing is now inflation. And recently you must have read in the paper, either in Bihar and part of India, a large segment of the population, they are getting into the shops because there was a slight rumor that the common salt price is going up from 20 rupees to 100 rupees. One fine morning you can see a big queues in the big shops for getting into the common salt because that any slight provocation about the pricing, people are extremely sensitive to the price movement. That is why the inflation has become a common man subject. And it is widely debated in the media, academics, and the banking circles, and financial circle, audit circles. All type of professionals are talking about inflation. So I have given some statistics about the inflation, and our current milestone or the signpost is 5% is the wholesale price index signpost, and the medium-term objective is 3%. So even though RBI or the government is looking at the CPA and the wholesale price index, still the anchoring index for monitoring the inflation is the wholesale price index, and CPA is also equally going to be focused by all the agencies, especially the Reserve Bank of India is also. But we have not articulated a particular signpost, or it's a what is the target we are set for the wholesale price consumer price index. That is one thing. Please note that one. So what is happening if you look at the analyze the trends of the inflation, the spike or the upturn in the inflation has started in the year 2009. It has moved to 7.1 territory, because anything beyond 5 or 5.5 is an unacceptable level of the wholesale price index. That was in December 2009. Then you have seen it is peaking to 10.88 percentage in April 2010, and then you started. And what is happening is there is a stubbornness or a steadily it is remaining at the elevated level of nearer to the double-digit inflation almost up to November 2011, and then it is slightly coming down. So many arguments, supply shocks, demand pressures, a lot of arguments have taken. But what it happens after 42 months of stubborn inflation closer to the double digit, it has come down to 4.6% in May 2013, and it is again upturned. Now the latest inflation figure of October is 7%, and the worst part of it is our consumer price inflation is almost 10.09%. So this is a problem which we are facing now. This is to be addressed to. That is why you have seen a lot of monetary actions. Now when you look at who are contributing to inflation, so I thought of giving you an August 11 to September 13. So significantly, it is now two groups are driving the inflation. One is the food articles, another is energy prices. Energy prices, you know that there was a pent-up pass-through was there. Now we started partially deregulating the prices, and diesel prices every month it is going up by 50 paise, and similarly petrol significantly liberalized, and gas prices subsidy has been limited to 9 cylinders per family. So this pass-through effects is significantly impacting, and similarly onion prices, you must have read in the newspaper, it is 100 rupees or 70 rupees. It's around almost 283%, that onion prices has gone up. It is significantly impacting the inflation now. So, but when you are looking at the contributors, this is I thought a comparison between the first 6 months of 2012, 13, and 13 and 14. You can see that 62% of the driver of the inflation is food items, 25% is the fuel, and rest of the items are only doing 14. Now we are really facing a problem of food inflation, and that is to be addressed. So that is what is again the driver of the inflation. We have I just thought of giving it. There is not much inflation. So what is driving the inflation? That broadly we divided into 4 or 5 factors. One is the sustained pressure on food prices. See, one is cyclical. Any monsoon problem is there, the vegetable prices and rest of the food items, it is cereals prices are going up. But the most important one is structural, because what is happening in the rural and urban sector is a significant consumer basket. The food habits are changing drastically in India. Almost either you take the rural segment or the urban sector. People earlier, they are mainly focusing on cereal-based consumption basket. Now a significant share of the protein basket is coming in, like egg, milk, meat, or vegetable, fruits. All these items are coming even in the rural areas. So these segments, production is not going up. It is very difficult to make any short-term changes in the capacity or increase in the production, whereas the consumption pattern is significantly altering in the economy because the disposable income is going up in the country. So this is a one segment. Then the pass-through, all of you are clear about the oil prices, and global commodity prices and rupee depreciation, because you have seen around 20% depreciation of the rupee, which has a first round of impact on our lot of items imported, and the second round is going to kick in now, and fiscal deficit is also driving it, and demand pressures. So these are the broad factors. So what is inflation dynamics? I thought a few points I should bring it to the notices. There is a real commitment, policy objectives of the RBI and the government is to maintain a stable inflationary environment. That is why the 5% wholesale price targeting, even though we don't have an inflation targeting formally, but there are written communications and messages communicated to the public that the milepost or the goalpost is 5% wholesale price index in the short term and 3% is in the medium to the long term. But what is happening is RBI has conducted a detailed study and through a multiple discriminant analysis to find out which level of inflation is ideal or neutral for sustainable growth. What we have found out that any inflation between 4 and 6% is the threshold level, and the moment you are having an inflation going beyond 6%, it is going to impact growth adversely. So anything less than 4% also influences the inflation. So the ideal level of inflation is 4 and 6%. So whatever you are talking about growth inflation dynamics, unless you keep the inflation 10 or 10%, it is not going to promote the growth. If at all you wanted to promote growth, it has to be somewhere around 4 and 6%. And similarly, when you do a study of the cost of sales or the sale, the interest is forming only 2.6% to 3%. So it is not a significant cost on the books because all of you are finance controllers and finance experts. If you disaggregate the total expenditure of the companies in their profit and loss account, what is the interest cost? The manufacturing companies we have taken it is coming around 2.6. So just because an interest rate is going up by 100 basis point or 200 basis, it's not going to significantly impact the growth. But again, we did a study. So what it says that any 100 basis point real increase in the growth, interest rate, it is going to impact the investment by 50 basis point and the growth by 20 basis point. So it is not that why the growth is coming down to 4 or 4.8. It is not entirely due to monetary policy tightening. It is other factors also should be taken into account. So this is three significant studies we have conducted. So then another year, what is happening is, whatever people argue that supply constraint, normally any supply side is a very short-term, transient in nature. But when you analyze the food prices in India over the past 5 years, it is very closer to 10% or above, some of them crossing around 18 to 20%. So it is no more considered a cyclical factor, it is more of structural rather than cyclical factor. This is the one factor because fundamentally this is because of the change in the consumption basket or the commodities they are consuming in the rural or in the urban sector. So another important aspect is even though we call it as supply side food inflation, it is becoming more structural. So it is impacting the inflation. When currently now one interesting aspect of our inflation is the vegetable prices are driving the inflation. But we have recently conducted another study of removing food prices and fuel prices from the CPI, Consumer Price Index. Still the inflation is going to be 8.5%. So that is why something is structural is there in the consumer price. This is to be addressed to. Unless we put more production capacity into the system or investment into the system and deal with the supply constraints on a long and sustaining basis, inflation is difficult to be managed. So another important aspect is this is one aspect which has studied our per capita income in Oman and Saudi Arabia. We are calling about $26,000 or $28,000, but ours is $1,500 per capita income. So any income it is going up into the country, and especially in the rural sector, the real wage has gone up almost 10% for the past 2 years, and the nominal wage has gone around 20%. So this has put a lot of money into the hands of the people, lot of disposable income at the hands of the people. So naturally, when they get more disposable income, ideally it should have gone into savings. But those people which are only consuming cereal-based goods, and when they are getting extra money, so the extra money they are spending on protein-rich items. That is why a lot of pressure, demand pressure has come into the protein-rich items. That is why we call it as protein inflation now. It is no more it is called food inflation. It is a protein inflation. Now what is happening, what is the impact? Even though it is a supply side phenomenon, so what happens in the real economy is when the supply side phenomenon, it is a food inflation or a fuel price inflation, always the expectation kicks in, and when that inflation is not managed at the supply side level, the expectation starts building up either in the rural sector or the urban sector. So we can convert it, this expectation into a generalized inflation. So it will be impacting not only the agriculture, the food items or the energy, fuel items, it can go into the industrial items, so it can kick into a general inflation. So there is always the monetary policy trying to achieve is deal with the expectation. We look at the real inflation plus the expectation. If the expectation is not addressed, either supply or a demand factor, it can kick in and cascade into a generalized inflation. That is what we are trying to address through the monetary policy. So there is a, just I thought I give some statistics about the relationship between inflation and growth. You can see from the presentation later, there is no, wherever you can find a inflation is beyond a sustainable level of 6%, eminently you can see there is an impact on the growth side. So there is an always, there is a necessary condition for a sustainable, stable growth. Inflation should be maintained around 4 to 6%. This is only a statistical presentation about a few years. So what RBI has done it? So what Reserve Bank of India over the 2009 to 2013, there are 3 distinct phases are there. So one phase is by the late 2009, inflation started going up and remaining at the very closer to the digit level around 48 months. So what during that period RBI has done is we have taken the CRR action, and the repo rate has gone up by 13 times. This is the first phase. But there are 2 types of extremely opposite arguments. Some group of people, either industry or the economists or academics, argued that we are too soft or baby steps or behind the curve. At the same time, some of them are say too hawkish. So, but the real reason, exactly what we are put it in your objective, growth inflation dynamics. So we are coming out of the crisis. There was a significant slowdown in our prediction or the GDP growth. We wanted a real growth should sustain. So that is why instead of putting almost a 200 basis point increase in the rate of interest, we have gone into a 25 basis or a 50 basis point into 13 times it has done. So what is the justification is much of the world is in the crisis mode, and the baby steps is nothing but a delicate balance of growth inflation dynamics. This is criticized. Some of them says we are too soft. But what is the second phase we have seen it is when the inflation started moderating. So again we started unwinding or cutting the rate of interest. The repo rate, it has come down. The CRR was cut by 125 basis point. It has brought down to 4%, and the repo rate has been reduced by 125 basis point. It has come down to 725. Again, what we are seeing in 2013, an upturn of inflation is taking place. So again, we started raising the rate of interest by 25 basis point in September as well as in October. So, but one thing, please note that again in August, September, we have one more pressure is coming. There was tremendous pressure in the exchange rates, and external sector vulnerability was there. So that is the one reason we started. Not only the inflation is growing not to double digits, nevertheless we have to change the repo rate only to address that exchange rate volatility as well. Now, what is the effectiveness of the measures? There are a lot of criticism, lot of debate. Just to look at the data, in the wholesale price inflation peak April 2010, it has gone up to 10.8. It has come down to 4.58%. So it is purely, it is a combination of fiscal, combination of supply, the combination of demand pressures, combination of monetary policy, it has come down. But again, if you look at the average, 2010-11, 9.3%. 2011-12, 8.9%. It has come down to 7.4, and currently we are running around 6.4%. So, but nevertheless, the thing is not well within the manageable or comfort zone. 7% rate is around 200 basis points above the signpost of the RBI's declared 5%. And similarly, the major worry nowadays is the consumer price inflation, which is going to 10.07%. So this is the inflation, this one. So what is the inflation outlook for us now? Fortunately, we are going to have a very good Kharif crop. Rabi is also going to be an extremely good one. We have already seen some change in the agricultural production. So this can mitigate some of the supply constraints, particularly the food items. Then, nevertheless, we are going to have a lot of adverse developments coming in. So there are already oil prices pass-through is continuing. Any change in the oil prices in the international financial market, it will have a cascading effect on us. And second one, the currency depreciation or the first round of the currency depreciation is already impacted. It is impacting the inflation. But the second round is possible to come in, and more administered prices are to be passed on. It is again going to have an impact on the inflation. This is the outlook. So in fact, what inflation growth dynamics is, the first priority of the government of India and the RBI is maintain a stable inflation. Number one. Number two, while doing that inflation, there could be some possibility of sacrificing some growth. So there is always a balance between the growth. If inflation is manageable, immediately the monetary authorities are cutting the rate, and with the objective of putting the growth back into the scenario. So both are the objectives, but only the priority changes according to the given situation. So now the another problem we have faced in the year, especially after May 2001, is the external sector volatility and extreme volatility in the foreign exchange rates. There are many reasons, all of you must be knowing it. First, I wanted to just bring it to your notice that just because the Dr. Vasudevan was telling that they are following an unconventional accommodative monetary policy, keeping the interest rate closer to zero, a lot of money is flowing into the emerging markets, and particularly India also got a lot of money. And when there was an inflation, yield differential was not very significant, factoring for the country risk or the exchange rate risk. So a lot of money has flown in. Just for unwinding of the carry trade alone, between May and August, almost 18 billion money, and particularly invested in government securities and corporate bonds, has moved out of the country, because these are all short-term volatile money. So when that much of money is going at a time, or a sudden stop and exit has significantly impacted our foreign exchange market. That is why you have seen 60 rupee hitting around 68 level and coming back to the current 62.44 or 62 or 61 level. So what we are trying to do is now the tapering is going to be deferred. Even December it is going to be unlikely. So what the monetary authority and the government of India is doing is put the internal house in order now, because we got a transition time. That is what we are working to it. So what is the external sector? You always you know what is happening in our balance of payment. What I wanted to straight away take it to you, these particular statistics, you just to take the current account deficit. So ideally, it is moving from 2.8% to 4.9%. And one important aspect which is pulling down our current account deficit is making a worst problem is the import of gold. Is almost 76% of the current account deficit in 2009-10 is on account of import of gold. It is going up to 88% and 72%, and again coming to 61%. And the current year, the first quarter, the report data, it is 73%. But the most important vulnerability factor is where because of the quantitative easing announcement, there was a sudden exit and and the stop and exit of capital was there. This has created some problem. And the most important aspect is the external debt. And the 44% of our external debt out of the 388 billion as of June, it is short-term debt. That is with a residual maturity of 1 year. But fortunately, all your deposit, all NRI deposit is also considered as short-term debts. We believe you, and there is absolutely the history proves that NRIs never exit the country. So we are not taking that 44% is a major vulnerability factor. But one good advantage is that the reserves, we have built up enough reserves, and IIP, that is a international investment position, is very adverse now. It is 277%. So some of the issues, but one point I wanted to bring to your notice, this non-deliverable forward contract market, which you can see in many places it is operating. And India is also a country which is facing this impact of the non-deliverable forward market. So one aspect of this forward, I just take a statistics. In 2010, almost 43% of the Indian rupee is traded outside the country. Even though rupee is not convertible, this is traded in the NDF market, including in Dubai. And in 2013 data has come, again 41% of this currency is traded outside the country. The entire NDF market is purely speculative in nature. Some of them are using for hedging purposes. But what is important aspect is those banks or the corporate entities have a transworld or a global presence. They are operating in the onshore as well as in the offshore market. So this is creating some sort of a vulnerability, transmitting from the offshore market to the onshore market. But unless we open up the capital account or allow more dynamic hedging, this is going to be a problem. So I don't want to go into the various steps taken. I'll just take to the conclusion. We are facing 4 major macroeconomic aspects, is already discussed. But most important thing is there are certain green shoots are visible, especially in the export sector, in the GDP growth, or in the agriculture sector, or in the power sector. What we are facing the problem is in the services sector and the industry sector, for which various policy measures are undertaken. And price and exchange rate stability is the main focus of that one. Now, when you are taking the order of inflation, exchange rate stability, and the growth, the first priority is now given on stabilizing the external sector. The second one is on inflation, and third one is only the growth. So the priority order has been changed dynamically. So what we have done is so many monetary policy measures, real sector policies are taken by the government and RBI, and these measures are found to be effective and showing some results. So rest is assured that India's story is still valid, and it is a temporary problem we faced for the last 2 years, some macroeconomic concerns. So that is being addressed too. I think I thought I will stop it at this point and take some questions.